I really would like to thank the Beijing Forum and Professor Yu for inviting me to this very interesting session and really stimulating. I really enjoyed the presentations in the morning. And I am, as the chair was saying, I am going to shift gear a little bit to really encourage us or probing us to think about how we actually finance urbanization. And we talked about in the morning slightly about hundreds of millions of more people will become urban residents, i.e. Through migration or through in situ urbanization. And we talked quite a bit about how peri-urban areas and also new villages becoming increasingly urban in nature and in lifestyle. So what I thought I would do in the 40 minutes or so really is to look at how unique China, particular Chinese cities are in terms of financing infrastructure. Obviously, we can think about infrastructure in a pretty broad sense. We can think about infrastructure all the way from ports, airports, to the kind of household infrastructure. We're looking at the pipelines, water, sewage, and even, as James talking about this morning, rainwater harvest. So really infrastructure as a broad base of physical infrastructure that is needed for urban lifestyle and urbanization. So want to place China really also in a more comparative context. That is to say, is China really different, or is China quite similar to other developing countries, particularly emerging economies? And to look at how China, particular cities, are either having very positive outcome in terms of generating the kind of growth that we've been seeing, particularly in terms of infrastructure development, but also the challenges that are facing Chinese cities. And just sort of in a sense, give you a little bit background. In the last 10 to 15 years, I've been looking at infrastructure financing, particularly through municipal finance, that is public sector finance. And today's topic, which is funded by the Lincoln Institute, that I actually look at how private sector can becoming increasingly a player in infrastructure financing and development. So today's presentation, I want to really look at some of the new trends coming on stage in China, as well as in other emerging economies, in terms of how the private sector can play a role in infrastructure. So clearly, that infrastructure traditionally has been the responsibilities of the public sector. Not always throughout history, infrastructure has always seen some privatizing or has been in some ways provided by players other than the private sector. But primarily, we're looking at infrastructure as a public good, much like the goods that we look at as the environmental commons, lakes, water, that are difficult to be divided. Infrastructure also can benefit from sort of the provision by public sector in terms of how much of infrastructure network could be shared among many people, and so the indivisibility of infrastructure renders it often as a public good. So you can see from this graph, this is developing countries as a whole, that the public sector or government is the primary financier of infrastructure. This is primarily in urban areas, urban infrastructure. So we're looking at roads, bridges, we're looking at energy, water, sewage, telecommunications, and in some ways also ports and airports. And you can also see, because this is developing countries, you can see quite a bit of multilateral and bilateral development banks, such as the World Bank, Asian Development Bank, and so on, that has a significant role in some parts of these countries. So private finance is very small together as a whole. Now, actually, let me move back to this. But even when we look to government finance or public finance of infrastructure, now if we dig a little bit deeper into how China is doing, and that is actually fundamentally different from many other developing countries, or developed countries. So let's say if we go to some of the Western countries, most local governments finance infrastructure through two primary means. One is property tax. Now, one way or another may not be called private property tax, but it's a tax on the real estates that localities have a claim on, or that are located in the localities. And in many developed countries, property taxes are the single largest sources of public finance at the local level, particularly for infrastructure. Now, the challenge with the local property taxes is that you have an annual steady inflow, but we also know that many infrastructure projects that are very large, let's say a large water a reservoir, let's say Shanghai built its newest reservoir about 5 years ago, and the amount of capital that's required upfront to build that infrastructure often could not be paid for upfront by property tax. So the second major largest source for many municipal governments around the world is what we call municipal bonds. That is raising money through the capital markets from both large investors, such as pension funds, mutual funds, and retail investors, such as residents and so on, who want to buy more stable income types of savings bonds. And so municipal bonds are a very, very important source of public finance around the world. Both sources are absent in China for Chinese cities. And so that's where we stand, in a sense that public finance in China, in Chinese cities, is very different. And so I want to place China in that situation. So because of that, we're seeing a very different kind of way of public finance in terms of how we pay for infrastructure in Chinese cities. And I don't have to tell you, because you are intimately familiar, most of you, with how this is done. This is done primarily through what we call 城投公司, so UDICs that are borrowing in a quasi-market fashion from primarily banks and cross-subsidizing across different activities these UDICs actually are involved in. Some UDICs are involved in not only infrastructure, building and financing, but also real estate that are more revenue-generating types of activities to cross-subsidize infrastructure. Now, we also know, because of 1994 tax reform, that there's a huge what we call 剪刀差, that the difference between municipal expenditure responsibilities, that is what they have to be responsible for in providing services and facilities at the local level, and their revenue sources. Because the tax system in China has been, since 1994, more centralized, local governments actually, through fiscal, meaning 财政收入, actually had much less share of the total national fiscal revenue since 1994. So there's a huge difference between what they are responsible for and what revenue sources they can generate through fiscal sources. So because of those three reasons, lack of municipal ability to issue bonds, lack of the ability to levy property taxes, and then the huge difference between expenditure responsibilities and revenue sources, most, if not all, Chinese local governments resort to what we call extra budgetary revenue sources to finance infrastructure. And that is primarily through, so these extra budgetary incomes are generally levied or generated by land, lease, or transfer revenues. And this has created a whole lot of incentives for local governments to really seriously engage in large-scale land development, often ahead of time. And many of us were talking over lunch and other occasions that the sort of the rapid overbuild of some very large both development projects as well as infrastructure projects, because the land lease becomes a perverse incentive to push local governments to develop more and more and to lease out more and more land, because that's how the revenue will come in for local finance. And so that also is a way to account for local GDP growth. So all of which essentially has been sort of termed by many scholars as sort of what we call land infrastructure leverage. And this table, I apologize, the numbers are really small, but all I need you to see is the circled numbers. This is actually a very conservative estimate for all of the prefecture level cities in China, that is 地级市, 地级以上市, that the land transfer fee by 2009, when reliable and adequate data were available in the last few years, that the percentage of infrastructure revenues that come from land transfer fee comes to close to 40%. And the more, I think, honest estimate will actually push that number up to, in some places, close to 70%, in other places, maybe close to 50%. Now, is this a problem, right? I mean, I guess, if there's not a problem, we shouldn't find a fix, but it has increasingly, in addition to what I just described as the perverse incentive, that this land infrastructure leverage has also created some new fiscal dilemmas at the local levels. That is, first of all, we all have come to realize that subnational debts since 2010, when the National Auditing Office began to reveal the extent in which local governments are in debt, that we realize how big it is. So in 2010, when the first report was coming out, it was about 27% of GDP, of China's national GDP, is sort of the equivalent of the aggregate local debts. And today, roughly about a year or so, that estimated was about 30%. And so now you can ask, is this really a problem? Because it's one pocket money from the other pocket, because the national government could bail these local governments out. But the issue here is that many of the localities have leased out land far beyond sort of the time horizon that a lot of localities essentially are running out of land, and then to continue to lease out. So then we begin to see the perverse incentives continues to work, that much more encroachment into agricultural land, much more encroachment into environmentally sensitive land. And so that perverse incentive also began to have significant impact on the environment and on agricultural land and food security in sort of indirectly. And so that's one problem. And the second really has to do with the kind of behavior that is driving this type of, or that is accompanying this type of public finance. That is, that we, there's, in the West, there's been quite a bit report of ghost cities in China, Guicheng, that because of the overbuilding of sort of overly expensive and less affordable types of both residential, commercial, and office space in places where investment and economic growth have been relatively moderate, and then so leaving many of these new development essentially empty of real occupants. And so that is also driving some of these new phenomena we're seeing around China, both in cities as well as in peri-urban areas, as well as in what we call the new countryside areas. So these are clearly not only challenges for local governments, but increasingly for the central government. So what are the alternatives? Do we have alternatives, right? So we know that local governments are in many ways physically constrained in terms of what they can do. And, but it's really interesting. So I was in China in the summer, this last summer, and trying to do some field work for this project. And then I come back yesterday, I was having some meetings with other researchers. And incredibly, in this matter of 2 months, there's huge change in terms of the budget law, as well as in terms of how UDICs are now being more constrained in terms of their borrowing capacity. And also in terms of what may be moving forward. But still, if we look at the alternative financing ways in which that many other countries are able to finance infrastructure, China is still looking for the reasonable or feasible alternatives. So we know local property taxes remains to be very politically sensitive and difficult to implement instrument. And municipal bonds, there are now 6 provinces and 4 cities that are able to issue municipal bonds, and that is increasingly being pushed out. But that also relies on a more developed capital market, as well as a system of credit rating of municipalities that can be significantly promoted. So both of these remain to be very, particularly municipal bonds still as a limited scope, and local property taxes is only 2 municipalities who experimented with. So not surprisingly, increasingly more and more Chinese cities are looking towards private participation. That is both through public-private partnerships, as well as through other types of private partnership participation. And the official sources of investment financing remains small, not insignificant, but small. So I think what we're looking at in the next a decade or so, that private participation is going to be a significant source of new finance for infrastructure. Now, this is not new, obviously. Private participation has started in the late 90s, and then in the new decade of the 2000s, we've seen quite a bit wastewater treatments, water plants, and so on with private participation. But the extent to which that actually counts for some large infrastructure is still limited. And I don't have to sort of belabor on this point. That is, there are significant advantages to private participation, but there are also significant costs and also disadvantages of private participation, and particularly in terms of the lower hanging fruits that I wanted to actually this graph that you can see that this is a comparison of 7 different emerging markets, countries that are somewhat similar to China: Brazil, Chile, India, Russia, South Africa, and Turkey. As you can see, private participation since 1990 to 2012 on this graph have been particularly concentrated in energy and in transport, and to much, much less extent in water and sewage. That is to say, there's quite a bit profit seeking clearly, rent seeking, and lower hanging fruit by these private providers in the most profitable sectors of infrastructure. So in China, particularly toll roads, ports maintenance, and then wind farm, some of the renewable sectors, wind farms, solar farms, have seen quite a bit significant private participation. So we know that there are some significant disadvantages to private participation, and the possibility in which that private potential windfall profits be ripped by private sector players. Compared to the other emerging economies, China actually is far behind in terms of attracting private participation. This is, of course, no surprise. We understand that China's infrastructure financing not only is dominated by the public sector, it is also dominated by the large state banks. So unlike the many other countries that we graphed here, that we do not use capital markets significantly, and we primarily is a bank-dominated financing structure. And so you're looking at development banks, like China Development Banks, or the 5 large commercial banks in China, and particularly the bailout or the package since 2008 significantly encouraged the easy access to bank credits by local governments to these 5 state banks as well as development banks. So it's very much dominated not only by public finance and also by bank finance. So it's primarily loans, which much like in the 1990s when we have a lot of state-owned enterprises that generated non-performing bank loans, now we're looking at many localities generating non-performing bank loans. So with that kind of dominance of public sector as well as public banks, large state banks, the space for private participation in China's urban infrastructure is very limited. So as you can see, China compared to all the other emerging markets is much, much less attractive to private participation in infrastructure. Now here we're looking at I'm actually not implying that these private participation comes from foreign sources. Most of them actually are domestic, or they are south to south. That is Hong Kong investment, Singaporean, Malaysian investments in China and in cities. So in fact, Western investment in Chinese urban infrastructure is very, very limited. So one thing I think you can see, a very small country, Chile, in Latin America, is probably the most active player around the world in terms of creating space for private participation. Now here I want to distinguish private participation from privatization. This is not to say that we're privatizing infrastructure such as ports, airports, roads to private ownership. It's far from that. We're looking at a number of possibilities. It could be from you build the highway and have the private party run it, right? It's management contract. Or you have a private entity like Pengyao Shuiwu to build a wastewater treatment plant and then operate it for 30 years and then subsequently transfer the plant to municipal ownership and operation. So what we call build, operate, transfer, BOT. Then all the way to privatizing. So certainly you could have that. So, but when we look at private participation, we're not looking at privatizing public assets. Now, in some cases, yes, but in most cases, no. So as I was mentioning, so the small space for private participation in China is clearly significant. On the other hand, we also are seeing the growth of a number of very large private financial players. Now we're looking at non-bank financial players. We're looking at pension funds, so 社会保险基金, so the national social security funds. We're looking at insurance companies like 太平保险 or 平安 and so on. We're looking at sovereign wealth funds, that is China Investment Corporation. We're looking at private equity such as Dinghui, or asset management companies. In China, there are a number of very large trusts that are now essentially lending to localities through these wealth management products. So in the financial sector, we begin to see the rise of a number of very large players, which actually begin to see infrastructure as a potentially profitable outlet for investment. Because, now this actually we don't have to go through, because infrastructure is long-term investment, and generally there's public involvement or some degree of government guarantee. And so it might be more long-term opportunity as well as low risk and very large investment. Now, there are also a number of other advantages to infrastructure. That said, that this sector of what we call institutional investors, both in China as well as around the world, have begun to see infrastructure sector together with real estate as well as private equity to see as a new asset class. And this sort of I mentioned quite a bit, and in particularly around developed countries, for instance, in both UK and US, we are seeing quite a bit institutional investment, particularly from pension funds. So if we look at the Canadian teachers' pension funds, we're looking at the Dutch national pension funds, we're looking at the California teachers' pension funds, they have now become a significant investor in the infrastructure sector. Now they can go into toll roads, they can go into other types of infrastructure, and sometimes they go in directly as an equity investor. So if you look at to the left of this chart, they go straight to the firm. For instance, the Singapore Sovereign Wealth Fund actually invested directly into the Beijing capital airport a number of years ago, although they backed out. So they oftentimes are like what we call the venture capitalists in manufacturing and high-tech sectors. In infrastructure, they go straight to firms or they go straight to funds. And so the debt over there by buying bonds or giving loans are increasingly not the way in which institutional investors going in. So now, okay, so we now know that there's the need for diversified source of finance for China's public infrastructure. And then there's this huge sector of new players in the financial sector, but matching them together has proven very challenging. That is to say, even though the asset volume of the aggregate institutional investors is very large, so we're looking at worldwide 50 trillion from some of the large institutional investors, less than 10%, and in China maybe close to 1% of that asset actually goes to infrastructure. There's a huge gap between what is sort of what we call available white powder money and what is actually invested in infrastructure projects. So that's one gap that is proven to be challenging. Second gap is that much of the institutional investment, particularly globally, has gone to, if they're going to infrastructure, has gone to developed countries. UK, other European countries, US, and in developing countries, Chile is your single largest recipient. And so for those developing countries, including China, now China is somewhat exceptional, but if you look around India or Southeast Asia and so on, even though there's a huge need for new investment, the actual investment from private investors is actually quite limited. So those, at least two major gaps, remain significant. Not only that, the gap between sort of the knowledge about the market and our knowledge in terms of at the local level in China, the demand for capital, also there's a huge gap. And most institutional investors, for instance, wants to come into projects or sectors in which the private sector is fairly developed, in which the projects tend to already be built. They want to have low risk, so they want to go for instance, a port has already been built in Ningbo or Shanghai, and then they want to come to manage instead of build the ports, because building new infrastructure involves much more risk beyond just regular business risk. And then they also prefer, oftentimes, much like venture capitalists, to go into funds or projects that have not gone public. That is, they can then maintain more control of the project as well as the funds. Now, then I talked to infrastructure providers, particularly 城投公司 around the Chinese cities. They're looking for something different. They're not looking for this type of just capital. For Chinese local governments, capital is not enough because they can get fairly low interest loans from state banks or development banks. They can get anywhere between 5% to 6% sort of loan rates. And then if you look at many of these institutional investors, they are looking for, I wanted to just really quickly show you the rates they're looking for. They're looking for, the investors are looking for returns in the upper one digit and low teens. So they are not going to lend you money at that kind of rate. So you're looking at 5 or 6% rate is very unlikely. And then the Chinese localities as well as local providers are also interested in investors that perhaps are more aware of what we call social responsible investing or social impact investing that could have an element of economic development rather than just profit as bottom line. So connecting that investor preference and then the local perception is yet another gap or challenge that we need to bridge. So really quickly, this is a global survey of institutional investors. And as you can see, that most of them prefer unlisted funds and then a direct investment. Essentially, it's a way in which they want to exercise more control over the operation and the business of the either the funds or companies. Then we look at unlisted funds in China, in the infrastructure sector. You can count with your two hands. There are only about less than 20 of these funds. These are pretty recent numbers, and most of the funds actually come from sources not far from China, particularly in the Greater China region. So very little from other international sources. And you can see here some of the key institutional investor players in China are the large institutional investors in China, the pension funds, the development banks, and so on. So as I mentioned here, so the the sort of the gaps between both the demand and supply, and the gap between the knowledge of investors and knowledge of local providers and local governments in China is significant. The gaps are significant. And so just looking at the rates in which institutional investors hope to obtain from infrastructure investment, it's quite a challenge for local governments in China to show that local infrastructure projects can actually have a good track records for these investors. On the top of these expectations, so this table, which I show here, is actually for more matured markets or more matured sectors. On top of that, most investors, particularly foreign investors, but certainly also some of the domestic institutional investors, also put what we call risk premiums on investment in China as well as in other emerging markets. That is regulatory risk, that is in a sense how much legal protection the investment can have as the project goes through long term. So we're looking at more than 10 years, at least 7 years, 10, and then 13 and 15. That kind of term, can we ensure, particularly at the local level, since local politics really vary from place to place, whether there will be adequate protection legally for private investment, and then the risk in currency, risk in demand, and risk in general businesses. So given those gaps, as well as given those risk premiums that many institutional investors impose on investment into China and China and other emerging markets, we can see here, this is just sort of in a way of looking forward that in what infrastructure sectors in China we might see increasingly more opportunities for private and participation. And that really in many ways, some are lower hanging fruits, particularly in terms of solar as parking lots and ports, but some is actually fundamentally important for cities, as we talked about water and so on this morning. And water and wastewater are increasingly a sector that allows for more and more private participation. And then in terms of medium prospects, we see a number of other possibilities. And then as you can see that for private participation, a number of sectors remain completely either still dominated by the state sector or very much uncertain in the sense of the prospects. And we will continue to see the traditional bank loans and fiscal allocation as an important investment vehicle in China. But the more interesting new trends are actually in the middle, that we are seeing Chinese cities being given more latitude, at least to experiment with municipal bonds, with regional infrastructure banks, which can actually be attractive to institutional investors by packaging different infrastructure projects together and making the cost of borrowing somewhere lower, but also by perhaps issuing sort of revenue-based bonds on the capital market to finance projects that are in secondary or third-tier cities, which by themselves have much less capacity to raise finance in the capital market. So, and then municipal development funds, and those are very much related. So we began to see movement in Guangdong, in Shanghai, in the sense of the sort of the first-tier provinces and cities that are began to act as intermediary that could attract institutional investors as well as retail investors, and then use those finance and investment to invest in smaller projects that are usually not attractive to institutional investors, but by packaging them together and becoming more attractive. But remain difficult, that in some ways in China is the foreign investment that could come in, particularly through funds or equity, and then the insurance players. So to conclude, really, in a sense, as I mentioned, that the institutional investors are a significant source, and they are looking towards infrastructure sector as a new asset class. But I think there's a lot of education to be done. That is, many of the institutional investors, particularly if you go to the United States, many of them are still doing fossil fuel investment, pipelines, midstream. And so there's a significant educational gap in terms of tapping these investors for green investment, because such green investment is really fundamental in preserving long-term economic growth, as you know, this title of the session is all about. And then how municipalities need to consider more consistent pipelines of projects, and creating the platforms that I just indicated that allow institutional investors or the investment to be funneled to smaller and more needy localities for investment. And then certainly, this I don't have to belabor either, that the infrastructure regulatory system and needs to be further considered. And that has to do with the kind of regulatory protection and dispute protection, so on. And I mentioned Chile as being a very important player now on the global capital market. Has a lot to do with Chile's legal protection in a sense of creating a more stable macro environment for investors. And last but not least, and I think much relevant to this session, that is we, starting, of course, from mostly the multilateral development banks, need to consider the use of financing vehicles specifically for green infrastructure, as well as for more sustainable infrastructure. That is to encourage both government players at the local and national level, as well as multinational development banks, to create incentives for investors to invest in more sustainable types of infrastructure. So that can be through green bonds or other kinds of green incentives. And I think that is already happening in China and certainly has happened in many other countries. So with that, I would end the presentation and be happy to answer any questions down the road. Thank you very much.